Now we're back and we're continuing with PowerPoint 2, the last half of PowerPoint 2. You recall from last time, in the last set of PowerPoints, we were talking about business transactions and how business transactions involved exchanges, and with these exchanges we had to identify at least two accounts and look at those accounts to determine the effects on these accounts, increases or decreases. And while we were working through these, we had to make sure that our accounting equation remained in balance. So with the transaction, if we increased the left side, the asset side, we had to increase the right side by the same amount. If we decreased the left side, we had to decrease the right by the same amount. This was very helpful, but it's like a first step. We need to go forward with this, and as we have already looked at this transaction analysis and accounting transactions, now we need to go on to 3, where we're going to start working with journal entries and what we call T accounts. Now it's called a T account because the shape of the account, the setup or the form that you use in the shape of a T. When we're done with our transactions, we do a trial balance. So the trial balance will just make sure that we are in balance. So it's a trial run to see if we're in balance before we prepare our balance sheet. The new thing in this chapter is also the classified balance sheet, which means we need to put things and classify them as to being current or non-current. If we understand current, then we can go on to 5 and work through the current ratio and all those concepts. So I'm going to end this show a second, and I'm going to go on forward to where we were. And we were down here about on PowerPoint slide 15. And we'll just start from this slide. If you notice here at the left, we first start at 1 where we analyze our transactions, and we've been working through daily transactions. Notice on the outer rim that says monthly adjustments. We are also going to have at the end of the month adjustments to record. It's not something we're going to get to in this set of PowerPoints, but later on in the semester we will, and these will have to be recorded. Right now we're going to go on to step 2, recording. We're going to do our journal entries. We're going to summarize those in T accounts. The summarization in T accounts is to help you so that you can better conceptualize or understand the effects of journal entries. After this, we have an unadjusted trial balance. That's on 4. If we did adjusting journal entries, we go back through and we go back up to 2, record adjusting journal entries, summarize those in T accounts, post them. Then we'd have in 4 a adjusted trial balance. And after the adjusted trial balance, then we do financial reporting, so financial statements. Even though we're going to be using T accounts and we're going to be writing out the journal entries, it's important for you to understand that most companies do use computerized accounting systems to handle a large number of transactions. If you take a class in Accounting Information Systems, which is another class that I teach, you'll learn all about this. All these daily transactions will be continued day after day, month after month, year after year. And they're the meat of what happens in the accounting system. However, at the end of the month or toward the end of the month, you'll start doing not the daily but the monthly adjustments and these adjusting entries. So this is kind of a cycle, and that's why it's represented here as a circle going round and round. Now, about journal entries and T accounts. It's probably the most difficult thing you must memorize this semester, and that is the debits and the credits. Accountants have these words, and the left side of a T account is a debit. And when we do journal entries, if it's in the left column, it's a debit. The right side of a T account is a credit, and the right side in a journal entry, that right column, is called a credit. The rules specify that assets have normal or expected debit balances, while liabilities and equities have credit balances. So if you go back to the accounting equation, you could draw a T account over the accounting equation, and you can see that the left side is the debit, which is the asset, and the right side, which is the credit, which would be the liabilities and the equity, that's the credit side. So what does all this mean? If you have an asset and it's an automobile and it's recorded in your balance sheet as an asset, it tends to have a debit balance. If you have a liability on the balance sheet, it has a credit balance. And if you have common stock, it also would have the credit balance. Again, this is probably the most difficult thing you have to think about. So here you have what I was talking about a moment ago. You notice, and I'm just going to use my pointer to show this to you, this goes across, that's the top part of the T, and this is the stem going down. So if you look at this, this is a T. This is the accounting equation, assets equal liabilities, stockholders' equity. This is the debit side. The asset has a normal debit balance, and it's on this side. Liabilities and stockholders' equity have credit balances, and they are on this side. So it's a bit more memorization, and I guess you've are starting to understand that this class builds. Every PowerPoint we add a little bit more to what we understand about accounting. And it's important that you understand things as we go along, because it just keeps building. Now we've gone from this accounting equation to using it to discuss T accounts, to using it to talk about debits and credits and the normal balances. So if we fill this in a bit, we could see that the normal balance for an asset account is on the left side, a debit. And liabilities and stockholders' equity have credit balances. And this symbolization in the middle is to symbolize that we must continue to be in balance as we work our way through this. So accounts increase on the same side as they appear in assets equal liabilities for stockholders' equity. If we want to increase our assets, we do it on the debit side. If we want to increase either liabilities or stockholders' equity, the increase arrow, we increase on the right-hand side. The left is debit, right is credit. Now I've thought about different ways for us to memorize this, and I like mnemonics, so I think of direct current. Now you can think of it in other ways. It's not alphabetically because C is before D, so credit would be before debit, and that's not the case at all. It's rather in reverse. And the other thing to think about here is that this is sometimes abbreviated DR, and credit is sometimes abbreviated CR. And sometimes when I take notes, I say D and I say C, or write D or C in the notes. And that's because the D stands for debit, the C stands for credit. And the normal balance agrees with the same side that it increases. So that's why you have down here increasing assets is a debit, increasing liabilities is a credit, increasing stockholders equity is a credit, and these are also the normal balance. So the normal and increase are on the same side. Now when we record these and we put these in a journal entry format, we would go through and we would do it a little bit different. We would formally write everything down. And this is a particular journal called a general journal. You'll get into which journals to use for which transactions later in your studies. For now, if we took those transactions where we just said up and down, and in the first one we had an exchange of cash coming in for common stock being issued. If we took this transaction and we wrote it out in its formal way in a general journal, we would show the cash going up, which is a debit, and we would list the debit first, and then we would say what's the credit, and the credit is the common stock. In these transactions, another important thing to note, not only do we have assets equal liabilities plus equity staying in balance, with each one of these journal entries, the total of the debits and the total of the credits have to be equal. So in the first one, the total of the debits is $10,000, only cash, and the total of the credits is $10,000, only common stock. In the next transactions, we have the purchase of logos and trademarks, a logo for the company. And I compared this to Nike's trademark, and they purchased it with cash. Cash is now going down. Cash goes up on the debit side, so it must go down on the credit side. Going down on the credit side, we also exchanged really one asset for another asset. We gave up cash and we got a trademark. So it was an even exchange of assets in this transaction. The asset trademark goes up, the asset cash goes down, and we talked about that and its effect on the accounting equation. Going down here to August 29th, we have a transaction in which we get software, an asset, it goes up, and we give up cash for it, but we also agree to pay with liabilities. We now owe more, our liabilities go up. Cash went down, it's credited. Accounts payable goes up, it is credited. So you notice an asset going down and an accounts payable going up are both credits. And that's because one is on the left side of the accounting transaction, the accounting equation, and one is on the right side. And that's what's happening. You have to have at least two financial statements elements affected by this. The debits and credits are always equal. Now, this one, again, was a little bit different, as I note over here to the left, because we do have three accounts, but we're still following our rules. The credits are 4 plus 5 for 9,000. The debits, 9,000. So it still followed the rule. Now, the next thing you would do after you write these down in your journal is you post them to your general ledger. Now, we had previously, in our previous set of PowerPoints, we talked about using an Excel spreadsheet for this, and we said this is not normally done. But it's the same concept we're using here because we are thinking about a running balance. So the running balance in the accounts is kept in something called the ledger. The ledger I think of as index cards. You've had exams in some of your classes where your teachers permitted you to bring in an index card. Maybe it's 3 by 5, maybe 4 by 6, and you put your notes on it. Well, these are like those index cards, only on each index card you have an account. Notice the account numbers here. The 186 and the 100, those are the account numbers which also show up in the general journal here. And this is from the chart of accounts, and these are asset accounts. The accounts payable starts with a 2, it's a liability account. The ledger card over here has it here. Now commonly, it's fairly common that you would put up here somewhere the name of this account. So 186 you would have had up here software, and here you would have had cash, and here you would add accounts payable. They put it instead right here in the debit and credit column. So the format could be a little bit different from company to company. This is debited, so they put it in here as a debit. It has a debit balance. This cash account goes down by 4,000. It is credited. And notice their running total that they're keeping on their ledger cards before this transaction, there was $24,700 in their cash account. When they make this check, they cut the check, they pay the $4,000 here, their cash account goes down by $4,000. The new balance is this. And I think it's probably a good thing at this point to review this cash account and see what's happening. I believe this first transaction was where we issued our stock and we got 10,000 in. The second transaction we gave up 300 and our balance went down. Then we got 20,000 more in, the balance goes up, we give up 5,000, and I think this was in paying off a debt. And now we're giving up another 4,000 here when we are buying this software and our balance goes down. So you see the normal balance, pardon me, got to get us back where we should be. The normal balance in this account is a debit balance, and it continues to be a debit balance here, but it's just that whenever we have credits, we are decreasing the balance. So when you work through the ledger and you're trying to figure out the balance over here, you have to remember our rules, which we had on the other slide and which I talked about, and how that's probably one of the more difficult things we learn in here, because these, which are credits, are going to reduce balances and the debits are increasing for the asset accounts. Now, the other account which we have besides the asset accounts is a liability account. And here we have a transaction which has us paying off this liability, or paying off the liability here. This accounts payable gets paid off here. Actually, I think I need to look at this a little more closely. I'm not too happy with the way this thing looks here. The $5,000 in accounts payable is credited, which they're showing it here as decreasing accounts payable. I think this slide is wrong, because here, when we increase our accounts payable, we should be increasing the amount we owe. So I want to tell you about this. The textbook author put the August 29th transaction on the wrong line for accounts payable. It should be on the next line for August 29th. It should go down here. So this thing is a little bit off. This should not be here. It should be here. And if we move this down, then everything makes sense. Hope this hasn't been too confusing for you. I want us to just look at this and say, okay, August 5th, my balance was $4,600 in liabilities. I went in here and bought the software. I paid for it by incurring $5,000 in debt. When I incurred the $5,000 in debt, my liability then goes up to $9,600. So now does this make sense? So the textbook author put this together wrong. I assume when you go and look at it in your textbook, it may be wrong there as well. So this is your heads up on that. 4,600, 5,000 increasing payable should be 9,600. Instead, they have 9,600. 5,000 increase is 4,600. No. If this were a 5,000 increase at this point, this balance would go up to what? It would go up to 14,600. So this is an error. This is an error in your textbook. Probably good that we note it here so that when you review, you'll understand. 4,600, 5,000 should not be there, should be here. Increase the balance to 9,600. Now, if we were to do this in T accounts, which is more helpful to you, when you look at this and you look at this, you see that in beginning in the software we had 0, we added 9,000, end up with 9,000 balance. The cash account is going to be adjusted here. It's going to have a total of 30,000 coming in here, and it's going to have 7,300 going out, and so I'm sorry, 9,300 going out. So this is 20,700. Accounts payable here is going to have a $5,000 adjustment for it. Again, this textbook author has really made things a little confusing here, but we do have a credit for $5,000 which should be put in, and it shows up as a credit. So let me go back to the previous slide again, and so I'll show you this again. This $5,000 credit should come in here on the 29th, and what happens on this one is they are showing it coming in on the 29th. And so whether you use the T accounts or whether you use the ledger cards, you're going to end up with the same balances, and you're going to work through them. You would work through them the same way. For some students, it's easier to use a T accounts, and they can think of it as a debit and a credit side and working through that way. For others, they like to work through those ledger accounts and the ledger cards. Let's go back through these now. Probably I confused you very much a moment ago, so let's go through and look at this again. When we issued the stock, well, if we recorded this in journal entries, we would record it this way. If we recorded it in our analysis where we have the accounting equation, we already went through that. If we translate that into a journal entry, it looks like that. If we put it in a T account, we're going to increase our cash. On the debit side is our increase, because again, you could visualize this as a big T account, the left side debit increase, and you're going to see that on the right side, common stock would be credited, and it is on this right hand side, everything on the right to increase is a credit. So it goes here. When we invest this one, we are swapping one asset for the other when we do this transaction, but we have to keep track of those accounts. We still have to keep track of the balance in cash. We still have to keep track of our balance in the logos and trademarks account. So as we work through this, we do still need to put in those separate accounts. And when we do it in our account balances, we're going to find that we had 10,000 coming in there. We are now giving up 300 of the 10,000 that came in from our selling of our stock. And so now our balance, if we kept track of a balance, it would be what? 9,700. Our logo started with no balance. We have now logos. We had no logos before, and our balance in there is 300. When we borrowed from the bank, our cash should go up. Now again, if you were keeping track of our running total and how much we have in our cash account, which is what is happening in your ledger, you would have had 9,700 at this point, and now we are adding 20,000, so 29,700 would have been your balance. Note payable gives us a balance of 20,000 that we owe in this account. We had no beginning balance, so that's our balance. When we bought our equipment, we paid for it with an accounts payable. Therefore, we record it this way, and we end up with a liability of an account payable and equipment. Before this point, we didn't have any equipment. And I note to the left here, it's quite a lot like the other one, because we are getting an asset, we are incurring a liability. They pay $5,000 to an equipment supplier. And what you have to think about with this one is that we are paying the cash, so we are paying cash, it's going down, but also our liabilities are going down. Liabilities have a normal credit balance from up here. You're going to debit it to make it go down, and that's what happens, and it's listed first because it's the debit. The credit is listed second, which is the cash, and the cash is going down. Again, an interesting thing about accounting, that if you really enjoy accounting and really seem to make sense to you, you'd notice here that as we've been going through, I've been trying to bring out the balance in our cash account, because our cash account balance keeps changing. And this represents the actual amount of cash which we have at the bank, because we've been cutting these checks. And we've been paying for things, and we've been getting deposits in. Also, when we look at our liabilities, we can see that what we owe to others keeps changing. And this is an accurate reflection of what we owe others. So the wonderful thing about this dual accounting system, which I note at the left, is that both balances are right. We know our cash balance and we know what's owed when we look through it. This is not keeping track of our balances. The ledger cards would, but it's showing the transactions and their effects. When we order software, since there's no true transaction, as we discussed before, we would not have a journal entry. However, when we do receive the software code in, then we are going to pay for it with cash, and we are also going to incur a liability. The software value is reflected by the amount of cash we gave up and the amount of the liability that we are incurring. So here you could go work your way through it, and you notice their notation here. Software, increase asset, cash, decrease asset, and payable, which is a liability, increases our payable. We now owe more. When we go to our T accounts, you could put this in the T accounts. The payable is a 5,000 credit. The asset for the software goes up by 9,000, and cash goes down by 4,000. Again, if we went through this and totaled everything up, we would get our balance in cash. Another thing I want us to know here is because now at this point we're getting quite a few debits and quite a few credits, particularly in this cash account. So how would you figure out what your balance is in cash? 10 and 20 is 30,000 in debits, and the credits are 9,300. So 30,000 minus 9,300 gives us our cash balance. So debits and credits are reversed, are subtracted from each other to get balances. And that's another interesting thing to think about. We bought supplies. The supplies were on accounts. We didn't pay for it with cash. We put it on our account. So when we do this, our assets go up, our liabilities go up. And since again, all of this to the right is increasing and has a normal balance as a credit, then we end up with the credit for 600, and the asset has an increase on normal balance on the left, which is a debit. Supplies will go up by 600, and put those in the accounts. When we look at all our T accounts, you can go through and you can calculate your ending balances in all the accounts at the end. This will accumulate just like it would if these were ledger accounts. So if we went to our little index cards and put them in the format which we had, we could work our way through this just as well. Now, the index cards balance or the T account balance, we're going to use those balance to prepare what we call a trial balance. Now, the reason why we're doing this is to make sure that our debits and credits are equal, and so that we can review for balances in the accounts to see if they make sense. And a person who has worked in the accounting system throughout the month will see all the things that are going in and out of the accounts, and they'll say, you know, I think those account balances look right or they don't look right. For example, I'm sure that if we sold common stock and it was $10,000 worth of common stock, this would be something that we would note, we would think about. And so when we prepare this, we're going to look at it and say, yes, I remember, that's right, we did have $10,000 from the common stock that we issued. The other thing is the debits and credits are equal. And we total these up. A lot of times you'll see the double lines. So these are double lines. And some other things we've done, we haven't done a double line. A double line means these are in balance. We are fine. These are balanced. Our debits and credits are equal. Now, where do we put these? You can either go to the ledger cards, you can go to the T accounts, and you can see whether it's a debit or credit. But you also should be thinking along the lines that the normal balance or where we expect the balance to be for these 5 first items are all assets, and we expect those to have a debit balance, which they do. These over here represent the liabilities and equity of the company. They should be credit balances, and yes, credit balances in each one of those accounts. And again, debits and credits are equal. When we do a classified balance sheet, the difference here between that and the balance sheet that we had in the previous PowerPoints is really that we have now current, this word current assets, and we have this word current liabilities. So you have to ask yourself if it has long-term benefits or if it's very fleeting. You're thinking along the lines of whether this thing will be converting into cash or changing itself into cash in the short time period or the long time period. And if it's a short time period, we call it current. And if it's a long time period, then it's not called current. So the current assets will be used up or turned into cash within the next 12 months from the balance sheet date. By August 31st, 2016, we know that cash will probably be used up. Now, we will have more cash coming in from other sources because we'll have sales and revenue sources that will bring the cash into us. Even after we've paid expenses, we should have cash. Supplies, we'll probably use up those supplies. Recall that the supplies were things like printer paper. We expect to use this up within the next year, so therefore we classify it that way. Equipment, on the other hand, is not going to be used up within the next year, nor do we expect our software to go away and not become valuable. We expect it can continue to have value, and we use our software hopefully for many years to come, as will we with our logo or our trademark. We expect to use those into the future. Most companies do not change their logo or trademark annually, so we don't classify these as current. We only classified the cash and the supplies as current. The current liabilities section, we expect this accounts payable to be paid off within 12 months of the balance sheet date. On the other hand, we have a note that we took out from the bank, and typically notes are not something that's going to be paid off within the next year. Typically notes go for longer periods of time. So it's not classified as current. Our total current liabilities include only this accounts payable, which we have incurred in the normal course of business and we expect to pay off clearly within the next year. It's probably going to be paid off within the next month. Another thing to think about is our ability to pay. How are we able to pay off our bills? So if you know the current assets up here are the ones that are going to become due, or we're going to have to pay with cash within the next year, and you know the current assets are the things that are going to come into us as cash or be transferred in as come cash in the next year, and you know the current liabilities are the things you're going to be paying off within the next year. A common ratio is the current ratio, which compares the amount of things that will be converted into cash and the amount of things which will be converted into cash payments. So cash coming in is the current assets expected within the next year, and current liabilities are the things that are expected to be paid out within the next year. And if you compare these, we would hope that we will have more current assets than current liabilities. In this case, a higher current ratio generally means a better ability to pay. With them, it's 2.09, so I guess twice as much current assets as current liabilities. Well, what is not recorded? Anything that goes through that is not through an exchange. And other things such as creativity, vision, if there's no exchange, then we don't record it. And when we put things on our books, what amount do we put in there? It's generally recorded at cost. Now, if we pay for something with cash or receive cash in, it's not difficult to come up with the value. However, if you don't have cash, what usually happens is you look to the liabilities, either the liability which is incurred for the thing or the liability which is paid off. In that case, it would be paid off with cash. And we use the liability amount to record values. So initially, you record all the things as we have in our transactions at their cash or their liability amounts. Thank you.